Nobody leaves here until you hand me an idea that I can shock the world with in a few days' time. You are all selfish mother...
Let's talk about finance lessons from the 5th episode of Billion Season 2 based on my work experience at Goldman Sachs in New York City and based on my work experience at the top hedge funds in the world. Now, please like, comment, and subscribe, and stick around because at the end of this video, I'm going to grade the episode for Wall Street Realism with a buy, hold, or sell rating. Now, in this video, we're going to talk about two different topics. Topic 1 is why day trading does not work. And during topic 1, we'll discuss exactly how the most successful hedge funds make money by thinking longer term. And we'll also talk about their research process, which you can easily learn. And then in topic 2, we'll discuss how governments change interest rates. Now, in topic 2, we will also discuss shorting currencies because Axe does this in this episode. And we'll discuss how George Soros made $1 billion in one day when he shorted the British pound. And this is a special situation because in almost all occasions, short-term trading does not work. Let's start with topic 1, which is day trading. In this episode, Axe's investments are down for the first time ever in a given quarter. And he's got 3 days left in the quarter to make money. And so what he does is he puts tremendous pressure on his portfolio managers and analysts to make money in only 3 days. But can they do it?
What do you have for me?
I'm peeling back the skin on Territory Petroleum. They're sitting on good numbers. If they come out and bump sevens.
Too late. When the numbers come out, we're dead man walking.
Now, that energy sector portfolio manager thinks that earnings will be great when the company reports, but it won't be until next quarter. So what other ideas do his employees have?
Ferguson.
Rip our liquid longs. I've got a few positions on my book that are ready for juicing, and we could add some classy names to the investors.
Window dressing.
Now, that analyst said to sell illiquid stocks that have lost him money and replace them with high-quality stocks before the end of the quarter. Why did he say that? Because if you manage over $100 million in assets, like Axe Capital does, then by law, you have to disclose to the market what you own every single quarter. And window dressing means let's buy a bunch of great stocks at the end of the quarter so investors see the amazing stocks that we own and not the losers that cost us money. But this does not solve Axe's problem of showing a negative return in the quarter. And Axe actually has issues trying to get his employees to day trade to make money really, really fast. And as a result, he explodes with this comment.
You are all playing it safe for the quarter so you have a shot of personally being up on the year. You are all selfish
Accurate. Now, at hedge funds, at least close to year end, portfolio managers like to lock in their profits so they get a bonus, which is often 10% of what the firm made that year. What is not accurate about this is that Axe is trying to force his employees to make money in 3 days by day trading. And later on in this video you're watching right now, I'll teach you how the best hedge funds invest. But first, and I say this with love of my heart, please, 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 do not day trade because it will all end badly. And there's a reason we cannot name a single day trader that's been successful primarily focused on day trading in the long run, because they don't exist. Why is that? Because in the short run, stocks go up or down for really random reasons outside of our control. For example, comments from political leaders or geopolitical issues like war, or anything that can make commodities like oil go up a lot or down a lot, or even economic data points like unemployment or inflation statistics can make stocks go up or down a lot, and it's really hard to forecast these short-term events. Now, each month has 20 weekdays, meaning 20 days that the major markets are open, and it's absolutely impossible. It's impossible to make money every month. Now, please read this book by Taleb called Fooled by Randomness for more details. Now, the worst thing that can ever happen to a new day trader is they make money on their first trade. Why is that? Because it's the exact same thing as going to a casino the first time and making money on your first bet. And people think it's repeatable, but the casino or the market always wins in the long run and not the gambler or the day trader. So please don't be seduced by day trading. And as Warren Buffett said, the longer the view, the wiser the intention. In fact, when Warren Buffett invests in a stock, he tells himself that he doesn't care if the stock market is closed for 10 years after he buys a stock. Buffett has owned Coca-Cola for decades, And he said if you bought Coke on the first day, meaning during the IPO, you would be down 50% 1 year later. But if you didn't sell a share, then of course you would have made a killing in the long run. Separately, look at this chart here from 2012 to 2024. It's basically a five-bagger if you just held onto it. Now, can you guess what investment this chart represents? And imagine how much money you would lose if you tried to day trade this chart. Now, do you know what investment this is? This is the S&P 500. And we'll talk about investing in individual stocks in a second. But when you invest, tell yourself, I don't know the path, but I know the destination. And you'll sleep better at night, and you won't pay as much in taxes as you pay less in capital gains tax if you hold something for more than a year before booking profits. And in a second, I'll show you how to do research on investments so you don't have to day trade and so you don't have to rely on only investing in ETFs. But first, if all you did was you put your 401k retirement annual savings of about $23,000 in the S&P 500 for every year for 20 years, then in 20 years you would have over $1 million. And if your spouse did it too, then you would have over $2 million. And you wouldn't have a heart attack every time the market sold off for random reasons that you can't control. So by being longer term focused, your wealth and your health will benefit. Now, if a hedge fund makes money every month, then they are cooking the books and potentially breaking the law with insider information. And the best performing hedge funds are actually not day traders. They put on 1 to 3 year positions with a very well thought out investment thesis that thoroughly analyzes the fundamentals of a company in the very long run. And the grandfather of hedge funds is Julian Robertson, who founded hedge fund Tiger in the 1980s. And he was very long-term focused. And many of his employees started their own longer-term focused hedge funds called Tiger Cubs, per these examples you see right here. And it's a misconception that successful hedge funds are day traders in the long run. Most of the money that successful hedge funds make are based on a handful of ideas each year that they do a ton of research on. And these companies that they invest in can double or triple in a year. So how do they do this research? Well, I'm going to show you. And by law, successful hedge funds have no information or knowledge edge or advantage over you. And so I created this 100-step investment idea spreadsheet that analyzes every aspect of a company based on your research. And this is based on my decades of investing experience. Now, in this spreadsheet, I ask you 730 questions based on your research that you type into the spreadsheet to help you with a long-term stock investment idea. And after completing the spreadsheet, you'll have a one-pager automatically created for you. Ignore my dummy data here. But this one-pager analyzes the company for you and helps you come up with a target price. Now, what's also included based on your research is a massive dashboard that visualizes your analysis and a 100-plus page investment research report as well. Now, there's 100 steps here in 3 categories that professional investors analyze, including qualitative research topics at the top here, quantitative research topics in the middle, and financial model-based research at the bottom. And the professional hedge funds have no edge on you because we all have access to the exact same research sources as they do, meaning annual reports, quarterly reports, press releases, online webcasts we can attend for free, investor relations content, etc. Now, each tab on this spreadsheet has a long YouTube video in the 20th row, you can click on it there, explaining in lots of detail how professional hedge funds complete each of the 100 steps. And qualitative research here includes analyzing the management team, catalysts, drivers, barriers to entry, and much more. Quick side note, I always start with analyzing the management team because ideas are commodities but execution is not. And I usually hate investing in companies where the founder is no longer running the company. Now, top hedge funds also analyze quantitative data like the total addressable market, market growth, market share, etc. And if you don't analyze the data, then you only have an opinion and not a well thought out investment idea. Then all this stuff feeds into the hedge fund's most important part of their investment research, which is financial research and building and forecasting your financial model in order to come up with a target price in the long run on the company that you're investing in. Now, do you ever look at a stock and think, I love this company, but it's expensive at 100 times this year or next year's earnings? Well, the best hedge funds and investors do not value companies based on their earnings estimates this year or next year. Rather, they value companies based on their earnings per share estimates in 3, 5, or 10 years from today. And this is why many stocks look expensive today to most investors. Now, years ago, I invested in Amazon as a long position at a hedge fund I worked at. And my colleagues would say to me, Chris, you're cray-cray to invest in Amazon because it trades at over 100 times earnings, and this is a widowmaker for you. And I said, no, it trades at only 4 times my earnings estimates in 5 years, meaning a PE of 4. So we need to really do our own research and forecast financial statements many years into the future in order to understand the true earnings power of companies that we want to invest in. And this is the secret to how many successful hedge funds make money. They're not day traders. They're long-term focused. And my clients and students use this and many other frameworks I created for them. So always do your own research and don't ever buy a stock after you watch a video of someone pitching a stock to you. Why? Because if you don't do your own research, then you might buy poor quality companies, or even worse, you might sell the stock if it goes down. And as Warren Buffett said, the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale. Now, instead of being day traders, successful investors that work at the top hedge funds spend a lot of time building their financial models, which you can easily do as well, instead of wasting time on looking at technical analysis. Now, don't only look at technicals for your investment research. Spend way more time forecasting your financial statements, which you can easily learn to do, which is what I teach. So how can you learn accounting and finance from scratch and also get access to this spreadsheet? Well, what you can do is you can check out my book that McGraw-Hill published called Finance Essentials for Managers, which gives you all the tools you need to succeed as a non-financial professional. And the link is in the description of this video to this book. And a link to download this spreadsheet and many other spreadsheets and resources are included in this book of mine. And I promise you that you will make much more money in the long run if you do your own thorough research instead of day trading. Now you might be thinking, Chris, how do I even come up with an idea of what stock to invest in? Well, it all begins with an investment theme. For example, let's go to a free website together called etfdb.com, meaning ETF database, where you can analyze thousands of ETFs. And let's scroll down right here and let's pick a random investment theme like lithium. Let's say you're bullish on lithium. Well, we can click here on lithium, for example, and then we could select a lithium ETF here, and we can look at the holdings of this lithium ETF, and we can start to do bottoms-up research on one of these companies here. Now, the way you know that you have a good investment idea is if you complete the entire 100 steps of the investment write-up. And this acts as a safety net so that we don't get seduced into day trading. Let's get back to Season 2, Episode 5 of Billions. How much is Axe Capital down this quarter?
If the quarter ended today, we'd be underwater like Crimson Tide. Sansomic has pulled us down to negative 2.3%.
So a down 2.3% return on a quarter is nothing, especially since this is Axe Capital's first down quarter ever. Nobody makes money every month or every quarter, and if they do, then statistically, they are likely doing something unethical. Now, if you chase performance into month or quarter end, then it will more often than not hurt you more in the long run. That much I promise you. Now, what some hedge funds do when they have a down quarter is they take their private venture capital investments, if they own them, and then they have their back office mark up the value of that asset in order to hide the losses in their stock market portfolio. And this could be unethical if not done correctly, of course. For example, let's say Axe Capital had a $500 million investment in a private AI venture-backed company that they own, and the value of the private investment went up a lot. Then what they could do is they could revalue or mark up that investment from, say, a $500 million investment to $1 billion investment, which would more than offset the 2.3% loss on the quarter. They do this all the time. Now, what other hedge funds do is if they're ever down, say, 4.9% in a month, and if they're worried about investors getting really upset in a month where they're down way more than 5%, then what they can do is they can take a knee, meaning they use options or adjust their stock portfolio so they don't lose more than 4.9% that month. Now, the best hedge funds don't usually have to consider doing this, though, because they have superb risk management metrics, meaning they will never be too long or too short the market, and they won't have more than 5% in any one stock, for example. And very sophisticated hedge funds use options to hedge their positions to ensure that they don't have a massive down month, which I talked about in this video right here, and the link is in the description to this video. Now, there are no ethical shortcuts, and Axe's most unethical portfolio manager has this to say in front of Axe and Axe's compliance director, who ensures that no insider information is used when investing.
The way I see it, we need a quick fix in a non-quick fix market.
Yeah.
I have an idea, but apparently I can't give it to you.
Now, when you're driving somewhere and you're running late, you might take a shortcut, but then you might get lost. And so never take a shortcut you've never taken before when you're in a hurry. Now, Axe's compliance director then tells Axe that it's okay to be down because you're human. So to get around this, Axe does this.
You are wrong. I'm not human. I am a machine. I'm a Terminator.
He then fired his compliance director because he does not know how to make money in the short run without breaking the law. Now, Axe could not get his equity, meaning stock market analyst, to give him an idea that can make money in only 3 days before the quarter ends. So he turns to another source to give Axe insider information on currency trading. And so topic 2 of 2 is how do governments change interest rates?
The Nigerian government is going to devalue their currency.
You know that?
The central bank governor told me.
Now, the central bank governor in Nigeria is the equivalent of the Federal Reserve in the United States. Now, if a stock or a currency goes down, investors can make money betting against it by shorting it. So in this case, the Central Bank of Nigeria is going to make the value of the Nigerian naira go down versus the US dollar. Why? Perhaps to get international investors to want to invest more in Nigeria. If a country's currency goes down, then all the stuff that country sells becomes cheaper, which attracts international investors, especially Chinese companies that want to purchase natural resources. And when central banks or the Federal Reserve wants their own currency to go down in value, what they do is they make it go down by cutting interest rates. So how does the central bank or the Federal Reserve cut interest rates in order to make the value of their currency go down? Well, they do so by increasing the supply of money out there. And we know that when the supply of anything like baseball or Pokemon cards goes up, then the price usually goes down and vice versa. So let me explain how this whole process works with a couple of props. Okay, this is kind of tight. There are 2 types of medicine that governments use to fix the economy, okay? One is called fiscal policy, which means spending money on stuff like highways to employ people and help the economy. And the other one is called monetary policy, which is the policy of money. Now, in this monetary policy medicine bag, we have a tool that can cut interest rates. Let's see what we have in here. Aha, here it is here. Okay, so we have a tool that can cut interest rates. How? Well, let's assume that I am the Federal Reserve in the United States, and you are all banks and investors. If I want to cut interest rates to jumpstart the economy, I can increase the money supply out there. This is fake money. Now, if the supply of money goes up, then the price goes down. And the price means interest rate. So how do I do this? Well, banks and investors own US government bonds. Let's pretend this is a US government bond that you own. Okay, so remember, I'm the government, I'm the Federal Reserve. What I'm going to do is I'm going to give you all money so I can buy this bond back from all of you. Okay, so here's your money, and I bought this bond back. Now, because there's more money out there, okay, in the marketplace, the supply of money goes up. Then that means that the price of money goes down, meaning interest rates go down. Now, if that's complicated, think about it this way. Let's pretend that I'm Nintendo, okay? And I made 3 of these products here, okay? 3 Marios. And the price of these 3 Marios is really, really high because it's a collector's item. Now, let's say that Nintendo makes 8 million more of these. Then the price of Mario will go down because the supply increased. So if I'm the Federal Reserve and I want to increase interest rates, then I need to decrease the amount of money out there, okay? So what I can do is I can sell bonds to you, okay? So I give this to you, and then you give me your money, okay? I sold this to you. Now there's less money out there in circulation. Now, the most powerful weapon any country has is the ability to change interest rates. Why is that? Well, let's go back in time together. Okay. It's 1944, and let me get my hat here, okay? It's 1944, and I'm Canadian. I was born in Canada. It's 1944, and I'm the Bank of Canada. I want to find a way to raise money so I can do my part in building tanks and stuff to help fight the bad people in World War II. How can I do this? Well, as you can see here, what I can do is I can sell you bonds. I sell you bonds, okay? And you give me your money. Then I use the money that you gave me to help ensure that freedom prevails. Now, imagine if the Bank of Canada can't do this anymore. Well, freedom and capitalism would not exist. Now, as a quick side note, now you probably understand why some left-leaning countries make cryptocurrencies illegal. It's because without the flexibility of selling bonds, governments would fail. And so the biggest threat to national security for some left-leaning countries is actually cryptocurrencies. Now, Bobby Axelrod realizes that if he wants to manipulate the value of the Nigerian naira by transacting in size to change the value of the naira versus the dollar, he can't do it himself because he does not have enough money. So instead, he does this.
Nigeria is going to devalue its currency.
Get the hell out of here.
How could you know that? Because we're going to make it happen.
So that's accurate. Axe actually set up what's called an idea dinner with other large hedge funds to help him with this trade. And idea dinners are very common on Wall Street so that hedge funds can talk their books, meaning promote their own holdings to other investors. Now, there are precedents for this idea dinner in this episode as well, because when George Soros forced the Bank of England in 1992 to devalue the pound and made $1 billion in one day, he partnered with other large hedge funds like what Bobby is trying to do right here. Now, you're probably thinking, Chris, wait a second. You said earlier that day trading does not work. Well, this is a special situation that involved billions of coordinated dollars and multiple financial services firms partnering together with each other. And even then, the risks are insanely high.
Currency plays are all about timing. You get in too late, there's nothing there. But you get in too early, they raise interest rates and bleed you out of your position.
Agreed. Being early is the same as being wrong.
Soros then did the exact same thing by partnering with other hedge funds in 1997 to short the Thai baht. And George Soros made another $1 billion in 2013 and 2014 by shorting the Japanese yen. Now, how much money does Axe want to invest in the currency short position?
The threshold is $5 billion. I'm in it for 2. That leaves 1 each for you 3. So, which is the more powerful driver? Boning me or your own self-interest?
Not accurate. There's no way that Axe would invest well over 20% of his portfolio in one trade. I mean, that's really poor risk management, especially since he's trying to throw a Hail Mary pass just to recoup a 2.3% quarterly loss. Let's talk about grading this episode for Wall Street Realism with a buy, hold, or sell rating. The episode did an awesome job of showing how hedge fund employees try to lock in profits by being very conservative with investing at the end of a quarter so they can lock in their bonus. And the episode also did a superb job of showing how an incredibly unethical hedge fund might try to chase performance with insider information and currency manipulation in order to profit. However, there is no way that a large hedge fund would put on a 20% risky position in a currency for the sole reason of offsetting a manageable 2.3% quarterly loss. As a result, I'm going to give this episode a hold rating. Please subscribe, and I will see you soon in our next reaction video when we react to Season 2, Episode 6. Thank you.